Picture this: your car breaks down, your roof starts leaking, your job unexpectedly disappears. Would you be ready for an unexpected emergency, or would your bank account start sweating harder than when that emergency happened? Today, we're going to tackle one of the most important but often overlooked questions when it comes to financial savings, and that is the emergency fund. How much should you really set aside? What does it look like? Now, there's an old saying 3 to 6 months of the emergency fund is really the golden standard, but is that kind of outdated? That can be very dependent on your situation. So let's break this down so you can sleep a little better at night, knowing all of those costs are covered. So, what exactly is an emergency fund? Now, the emergency fund is cash or cash equivalents that are set aside for urgent, unexpected, essential expenses. Think about that. You can really stretch the truth and you can stretch what you consider an emergency as in something you didn't save for, but something that you can find a reason or logic your way into using this money for something that is not a true emergency. Key point: it is not for any planned expenses. These include vacations, home upgrades, tech upgrades, expenses that should be within your budget itself do not fall into that classification of an emergency. So, why does this matter? Without one, you're vulnerable on taking high interest debt, which most people do when you look at credit cards, when you look at payday loans, when you look at unsecured loans. Anytime that life throws a curveball that you need additional funds, people are looking to borrow it and borrowing it at a very, very high rate. So, what does it matter? Accessibility matters when it comes to the emergency fund. The need to be liquid, the need to be low risk, and the need to not be tied up. This is why we have always said, do not invest your emergency fund. It should not be in the stock market. If a stock market, let's say, has a 30% correction and it is down 30%, I don't want you to have to pull your emergency fund out of the stock market, locking in that 30% loss because it was invested when it shouldn't have been. So think of it kind of as a personal shock absorber. Your car might hit a pothole, but your wallet is not going to completely fall apart when an emergency happens. So thinking of that old rule, we're looking at 3 to 6 months. Does it really make sense to save that amount of money? We want to cover the essential expenses. We are talking housing, utilities, food, insurance, transportation, minimum debt payments included. So if you have minimum payments on credit cards or loan payments, this is not going to include Netflix, dining out, luxuries, things again that you can kind of rationalize into making it into that emergency fund. Now, why 3 to 6 months? Why has this magical number been around for so long? That's usually how long it takes to find a new job, to recover from a setback, depending on how big of a financial responsibility it is. But this could also be some effectives like the job market. Cost of living has changed. Gig work, side hustle, self-employed, single household incomes may need a little bit more of a cushion depending on what you do. And others with stable job, you might need a little bit less when it comes to the emergency fund. So how do we calculate this? Again, thinking of rent or your mortgage, utilities, groceries, insurance, minimum debt payment, transportation, your car payment and your insurance, that is what you should have as a 1 month emergency fund. That is literally 30 days of expenses in a nutshell. So how do we build in this safety cushion? Depends again on the scenario, which we're going to go over 3 of them. First one being low stability, meaning you're freelance, you're self-employed, volatility in the industry, meaning you have very low stability in your job itself. We are thinking 9 to 12 months. Now, this could also include if you're kind of doing this freelance work, if you're doing YouTube, if you have a job that is seasonal, if you have a job that is very sales orientated. I do not want that whole deck of cards to tumble just because you've had a couple months or slump sales, depending on tariffs, depending on the economy. A lot of different things can affect. So if you do have a high variability of income, definitely getting that 9 to 12 months. Now, when we look at a modern stability, dual income is going to be one of these, where if you are reliant on more than one income, if you have decent job security, we're looking about 4 to 6 months. And if you have a high stability, meaning your job probably is not going to go anywhere, you could even look at government jobs, maybe guaranteed income, tenured positions, maybe 3 to 4 months. So you can see the variety right in here when we're looking at 3 months on one side of the spectrum, up to 12 months on the other side of the spectrum, which is again going to be very dependent on the type of job that you have, if you have a single income or if you have a dual income, and also the stability of the job that you have. So think about it. If you spend $3,000 a month, you want that 6-month cushion. That gives you $18,000 in an emergency fund, and it is only going to be used for emergencies like we've said. So pro tip on this one, guys, start with a mini emergency fund. Dave Ramsey, baby step number one, says $1,000 in that small emergency fund before you build it into really that full number, that 3, 6, 12-month emergency fund that you do have built. So where do we keep this? This again is one of the absolute biggest mistakes that I see people. They will take this emergency fund, they will throw it in a regular savings account at a traditional bank. It's not going to earn any interest. And essentially, that emergency fund is going to be losing money really month after month, year after year due to inflation. You want to make sure that it is parked into a high yield savings account. Now, I have a link down below for M1. They have 4% on a high yield savings account, making sure one, it's accessible. Two, it is covered by the FDIC or the NCUA, and it is earning interest kind of at or above that inflation, so you're not losing money. This could also apply to those money market savings accounts. Higher savings yield, still accessible. And some people even look, depending on the term, into some shorter term CDs, as long as there's not a big penalty. When you start thinking of an emergency fund, and let's say, for instance, you have 6 months of an emergency, even if you took 3 months of that emergency fund, put it into a short term CD, that was yielding a pretty high return, saving that other 3 months of the emergency fund. Again, you could do that, but risk is if you needed access to the full funds, would you have access to it within that time frame? Now, of course, things we want to avoid: one, the stock market, anything that is going to be volatile. I have seen people's emergency fund that are one, invested in the stock market, two, the emergency funds in cryptocurrency. That is not smart. That is not how it works. You do not want to lock up any of the money in retirement accounts that you do not have access to. So how do we build this? When we start thinking of an emergency fund, it is super, super simple to build. Automate your transfers from your checking to your savings or from your payroll account, regardless of how you get paid, going to a separate account that you have accessibility to, but maybe not as easy as just a transfer within a financial institution. You can also use your side hustle. You can use bonus income, accelerating your growth, selling unused junk. Now, this goes back to Dave Ramsey philosophy. When you need to liquidate everything you need if you're in a dire situation, absolutely selling junk you don't use. And every time you pay off debt, redirecting that payment into that savings account to build that up. Now, what is the psychological benefits? When we think bigger picture, having this emergency fund reduces your stress and reduces the panic in emergency situations because you already have it covered. It gives you confidence within your finances. You're not going to be completely derailed when it comes to something that happens that is a tried and true emergency. And of course, it can turn your potential financial disaster into something that is just a little bit of an inconvenience. So the question was, how much savings for an emergency fund is enough? It is enough to survive, to stay out of debt, to not have to borrow any money, and to breathe easy. Having that 3 months up to 12 months of a full emergency, really starting to build it consistently. And remember, your emergency is not anything for a luxury. It is about the necessity of moving forward and not crushing your finances. If you found this breakdown helpful, hit the like button, share it with someone who is just winging it when it comes to that emergency fund. Subscribe for more no fluff personal finance tips that come out every day. And until next time, stay prepared, stay secured, stay smart with your money, and I'll catch you in the next one.